Before you make a single move in natural gas or crude oil today, stop. Just stop for a second. Because right now, the market is sitting at a crossroads that most retail traders are completely misreading. And if you trade based on what you feel instead of what the chart is actually telling you, today could be a very expensive lesson. But if you stay with me for the next few minutes, you're going to walk away with a clear picture of exactly where these markets are right now, where they are most likely heading next, and what the key levels are that you absolutely cannot afford to ignore. I'm going to break this down for you the same way I would explain it to a friend sitting right next to me. No complicated jargon, no unnecessary noise, just the price action, the fundamentals driving it, and the levels that actually matter. Let us start with natural gas because that is where the real story is unfolding right now. Here is what you need to understand about natural gas at this moment. The market has been bouncing. After a pretty significant sell-off, prices started recovering. And there is a real-world reason for that. Across the northeast United States, a serious winter storm has been rolling through. Flights are being canceled by the thousands. People are losing power. Roads are shut down. And when that kind of cold hits that kind of region, heating demand spikes. And natural gas prices notice. So yes, the rebound you are seeing right now has a genuine reason behind it, but here is the part you need to be careful about. Just because the weather is bad does not automatically mean prices are going to shoot up the way they did a few months ago. Remember when natural gas went from around the 280 level all the way past 600 in just 10 to 15 days? That was a very specific set of circumstances lining up all at once. Right now, the fundamentals do not fully support that kind of explosive move. Production out of the United States is still healthy. Exports are continuing at a steady pace. And the weekly storage data is showing a withdrawal that is actually smaller than the 5-year average, which tells you that supply is still comfortable. The market wants to go higher, but it needs more fuel to really break out and sustain that move. This is an important distinction to carry with you as you look at the charts today. Now let me give you the other side of this, because there is a quietly building bullish case that you should not ignore. One of the major weather analytics groups is now forecasting a polar vortex pattern for mid-March. We are talking about below normal temperatures potentially hitting up to 18 states across the lower 48. If that forecast holds, heating demand could surge again, and the market is already beginning to price that possibility in, slowly but noticeably. I want you to pay attention to that word, slowly. The market is not running toward that news. It is creeping, and that tells you something important about trader sentiment right now. People are interested, but they are not yet convinced. They are watching. They are waiting to see if the cold weather actually materializes before they commit real money. On the other side of that equation, a separate forecasting group is calling for above normal temperatures through the first week of March. That means warming conditions, lower heating demand, and continued downward pressure on prices in the near term. So what you have right now is a natural gas market caught between two competing weather stories, one bearish, one bullish, and prices consolidating right in the middle of both of them. This is the environment you are trading in today, and understanding it clearly is the first step to not getting caught on the wrong side of a move. Now let me walk you through the technical picture for natural gas and give you the exact levels that matter. The most important thing I want you to focus on right now is the trend line and the 263 zone. Price needs to hold above 263 on a sustained basis. If it cannot hold there, if it breaks below that level and starts trading underneath it, then the downside opens up meaningfully. The first meaningful support you are going to find on the way down is around 259.8. That is not a random number. That is the level where price consolidated before the last breakout, which made it a demand zone, and demand zones tend to attract price when things pull back. If the market breaks through 259.8 and some warmer weather news comes out giving the bears more confidence, the next level to watch is 258. And below 258, you are looking at 255 as your next major floor. Now flip it around and look at the upside. The key zone on the bullish side is 264 to 265. If natural gas can get a sustained close above 265 on a 30-minute chart, not just a spike, but an actual close and hold, then the path opens toward 267.5. After 267, the next significant resistance wall is sitting right around 272. That is where a major trend line is coming in from above, and price has already been rejected from that area before. If it tries again and fails, that rejection could set up a very clean short opportunity. But if natural gas manages to close convincingly above that trend line, then you are looking at a potential move toward 275, which is a major supply zone. And if the bulls are truly in control and that supply zone gets taken out too, the longer-term chart is showing 295 as a real possibility. That is the bigger picture, but we trade what is in front of us, and right now, 265 is the line in the sand. Let us shift over to crude oil now, because the story there is quite different, and you need to approach it with a different mindset. The single biggest fundamental driver hanging over crude right now is the diplomatic situation between the United States and Iran. There is a meeting happening in Geneva, and depending on how that meeting goes, you are looking at two very different market outcomes. If the talks go well, and there is meaningful progress toward any kind of agreement, that is bearish for crude oil. A diplomatic resolution removes the risk of supply disruption from one of the world's major oil-producing regions. And when risk comes off the table, oil prices tend to follow it lower. On the other hand, if the talks collapse, if tensions escalate, if there is any kind of military action or credible threat of it, prices could move sharply higher in a very short period of time. Both outcomes are genuinely possible right now, and the market is fully aware of that uncertainty. That awareness is exactly why you are watching weaker buyers exit their positions right now. They made some money on the long side, and they are not willing to sit through a binary geopolitical event with that much open risk. What you are watching is profit-taking, not a trend reversal. Keep that distinction firmly in your mind because it changes how you should be reading the current price action. On top of the geopolitical picture, there was a significant inventory number that came out recently. The API data showed a build of around 11.4 million barrels, while the market had been expecting a draw of about 1.8 million barrels. That is a massive miss in the wrong direction. A big inventory build means more supply sitting in storage, and more supply is bearish for price. U.S. crude was already pulling back modestly, and this data put additional pressure on top of an already cautious market. The pattern forming on the crude oil chart reflects all of this. You are seeing lower highs developing, which tells you the market is struggling to hold its upside gains. The bulls are buying every dip, but the bears keep capping the rallies. That kind of structure does not resolve gradually. It resolves with a decisive break, either up or down, and the level that will tell you which direction is coming is 59.55. Price recently bounced off that level, which means it acted as support. But if 59.55 breaks cleanly and the market starts closing below it consistently, that is a serious warning signal. It would mean the demand sitting at that level has been absorbed and exhausted. Once demand at a key level is gone, price tends to fall quickly to the next zone where fresh buyers are waiting. Below 59.55, the next support area comes in around 59.23. After that, you have a gap zone near the 59.80 area that could provide a minor cushion on the way down. If the selling picks up momentum and geopolitical news turns positive for supply, then you're looking at 5800 as the next major support level, followed by 5730 and then 5650 as the next significant demand areas. And if selling really accelerates, if this entire consolidation structure that has been building since mid-February completely breaks down, then 5600 becomes your next meaningful floor on the chart. Now, look at the other side of the crude oil picture. The market has been consolidating in a defined range since February 19th, and the top of that range is sitting between 61.35 and 61.50. If crude oil pushes above that zone and holds, if you see sustained trading above 61.50 rather than just a brief spike that fails, That is your breakout signal. A confirmed breakout above 61.50 would initially open the door toward 61.80, then 62.20, and then 62.50 as the next resistance levels. And if the market can get above the daily chart trend line that has been capping price action for some time now, the longer-term target starts to show 6,500 as a realistic destination. That is a significant move from current levels, and it would require either the geopolitical situation to stay tense or a major cold weather event to materialize and provide the demand side with real conviction. Let me now bring all of this together in a way that is actually useful for how you trade today. Right now, both natural gas and crude oil are sitting at genuine decision points. They are both consolidating. They are both waiting for a catalyst. And in that kind of environment, the worst thing you can do is force a trade. Forcing a trade in a consolidating market is one of the most reliable ways to get chopped up and frustrated. You buy at the top of the range, price pulls back, you get stopped out. Then it reverses. You buy again, it pulls back again. That cycle repeats until your account is smaller, your confidence is shaken, and you start making emotional decisions. The smart approach right now is to identify your levels, and you now have them clearly, and then wait for price to tell you something before you act. For natural gas, you are watching 265 on the upside and 263 on the downside. One of those levels will break with real conviction before this week is out. When it does, that is your signal to respond. For crude oil, you are watching 6135 to 6150 on the upside and 5955 on the downside. The same principle applies. Let the market show its hand first, and then you react to what it does rather than trying to predict what it is going to do. That shift in mindset, from predicting to reacting, is one of the most important changes any trader can make. There is one more thing worth saying before we close, and it applies to every single position you carry right now. The geopolitical situation with Iran is a genuine wild card. Markets can and do gap significantly on news of that nature. If you are holding positions overnight during this window, make sure your size is appropriate for the uncertainty you are carrying. Do not let one unexpected news event blow up your entire week. Risk management is not just a concept you read about in books. It is the actual thing that keeps you in the game long enough to reach your goals. One bad trade does not end you. One bad trade that you held too large with no stop. That one can set you back months. Know your levels. Know your stop. Know exactly how much you are willing to lose before you click the button. That discipline is what separates the traders who are still here 5 years from now from the ones who quit after 6 months of getting hurt. All right, that is your complete breakdown of natural gas and crude oil for today. Natural gas is watching 263 as critical support and 265 as the upside trigger, with a mid-March polar vortex forecast as the key bullish wildcard to monitor. Crude oil is watching the 59.55 support zone and the 61.35 to 61.50 breakout level, with the Geneva diplomatic talks sitting as the major geopolitical catalyst that could push prices hard in either direction. Both markets are at turning points. Both require patience and precision right now. Watch your levels, wait for confirmation, and trade what you actually see, not what you hope is going to happen. Stay sharp out there.